Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Tuesday, September 25, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. So we had a slight down day today across the markets. Really, it was more of a rounding error type of day. When you look at the SPDR, we were down a quarter, less than 0.1% for the most part. We're still bouncing around a little bit here as I make this video. And the SPS cash index was down a little less than 4 points. So you can see that 4 points on an index that's 2,900 is more of a rounding error. It's about 0.13%. The Dow Jones Industrial Average down less than 70 points. And the NASDAQ Composite was actually up 14. We'll get to that later. It's interesting. It factors into one of our puzzle pieces. Also, we'll talk about the transports, which were down today, and that chart begins to look interesting also. Let's look at the bigger picture. We'll look at the smaller picture. We'll reiterate what my thought process is, and we'll also look at both sides of the market because it's required to be successful in this business. It's required to look at both sides of the market. You have to be aware of the upside and the downside, whether you're in a long trade or a short trade. You have to be able to identify where you're wrong. I'm currently in a short trade. You all know that if you've been watching these videos for any length of time. We were in a long trade on the run up. Now I'm in a short trade. You're all aware of it, so we'll discuss it through tonight, and I'll tell you exactly what my thought process is. Before we move on and do that, let me pause and thank everybody for participating and making comments underneath the videos. Please continue to participate. I love the interaction. Your thoughts are important. They're important to me. They're helpful to the entire community. Please continue to do so. In addition, hit the like button on the video and also share the video with anyone you think can benefit from this information. Okay, let's get back to the market. So, on the short term, you know I've been looking for some downside. That began several days ago. It began even before the market peaked out. So that's come to fruition. It's playing out. But here's where we are. We're at an important inflection point. And know this, the market's not going to give up the ghost that easily. It generally doesn't. And what I mean by that is, when the market is bullish and we're in an uptrend, there's still a bunch of buy the dip mentality traders and investors out there. So each and every time the market goes down a little bit, it gets bought up. Unless it's going down on significant volume, it's unlikely to get very far on the downside because of the buy the dip crowd out there. So when I say we're at an important inflection point, where are we? Well, we're hovering right on top of the 20-period moving average in the SPDR. So the question is, are we going to just hover and bounce off this area, touch the 20, maybe spike through it by a little bit, and then reverse and continue higher and make new highs in this market? That is possible. We need to be aware of that. If that begins to happen, I'll first become aware that there's a potential market reversal at hand on an hourly basis, and then we'll certainly be able to identify it on a daily basis, and then I'll have to take a loss, likely in some of the put positions that I have. But understand this, when I have positions on, and the market hands me a gain very, very quickly, even if it's a 15, 20, 25% gain, I'm going to book some profit in that position. That's what happened yesterday. The market handed me early on a very quick and handsome profit very quickly in the put positions, or at least part of them that I had on. So I did take part of those positions off. However, I'm completely willing to put those positions back on if the market bounces off the 20-period moving average, for example, and I don't think we're going to make new highs. We'll make that determination in real time. It's nothing we can discuss today. I'm just giving you some insight into some of my thought process, and remember, in my mind is a dangerous place to be. But in this business, sometimes we have to think a step 2 or 3 ahead of the game to understand what we anticipate the market doing, what we would likely do in the event that that does take place, so that we don't have to begin to think about what type of trade to put on if the market makes a certain type of move. We want to pre-plan our positions. What's the critical area on the downside? That's the most important thing that we need to discuss. And for me, right now, it's this pivot low right here. That's what I'm going to call the critical point on the downside. For example, if we begin closing hourly below that level, I'm going to consider that the first sign that bearish behavior is really escalating, if you will, starting to pick up steam. The snowball is rolling down the hill. It's getting larger. So any daily close below that level, and I'm going to consider that the 50-period moving average is going to come into play relatively quickly. Now, what does that really mean in terms relatively quickly? So everybody has a different idea of relatively quickly, and what I mean by that is I get emails about, what I said I put options positions on. These are the puts that I have on, that I had on. I had the IWM, I have on the SPY, and I have on the triple Qs. I have on all three, but I did take profit in some of them when we took a dip lower yesterday. However, we have a different idea of what long-term, short-term, intermediate term is. I do not buy weekly calls, weekly puts for the most part. Once in a while, I will. On a Monday, would I buy an expiring Friday call or put? I will if I have a high confidence that something is going to happen relatively quickly. Yes, I will. Generally speaking, when I'm making a positional trade, it's a swing trade. I'm buying the normal expiration options. That's the third Friday of the month, and I'm usually giving myself time. So I'm not buying the near-term expiration. And in some cases, I may be buying 2 or 3 months out. And I bring this up for a specific reason, because the market does what it's going to do. When the market's in a corrective state, for example, it will have large swings in both directions. So the market can come down, it can bust through the 20-period moving average. It can have a really poor down day, for example. It could find support at the next breakup candle low, 286.98. So just say 287 for argument's sake, which is about 30 to 35 S&P handles below where we are now. This is a hypothetical, but there's a point. There's a method to the madness. I'm telling you this for a reason. You can have a near-term option position on. It doesn't even have to be something expiring this week. It could be something expiring next week. The market could come down. Those options could be way in the money. You could be making a fortune in those options on that day if you bought them in a reasonable period of time to when the market dropped. And what I'm telling you, most traders understand this. Most people watching this video understand this to be the case, but some don't. And that's one of the reasons why I'm telling you, is because it's for the benefit of those that don't. You need to be careful. Don't fall into this trap. You need to be careful, because if the market turned around really quickly at 287 in that hypothetical example and found itself within an hour or two, for argument's sake, up 20 handles from the low in the S&P, those options and that gain you have is wiped out, and it's unfortunate. It happens. It's unlikely coming back. It's likely a reversal that'll last for a couple of days, and guess what? You can kiss those options goodbye. I've been there. Most of us have been there. You go to lunch, you come back, and you're in a losing position. You go to take a leak, you come back, you're in a losing position. We've all been there. It happens with those shorter dated options. That's why you need to be extremely careful and extremely quick when trading those near dated options. So on the downside, we're going to have to watch out for this breakup candle low, 289.55. That's a spot of interest. This other low right here, this pivot low, is 289.03. So in that zone, we are likely to find some support in this market. If not, if we begin closing hourly and then certainly daily below that, the next pivot low, also around the 50-period moving average, comes into play, comes into focus. All right, on the upside, how about today's high? Why is today's high important to me? I'll explain why I think that's important. They had an opportunity to fill a gap today and failed. In fact, let me go down to an intraday chart and go through it there. I think it'll be more beneficial. So here's an intraday 10-minute chart. Let's just get a sense. Let's get our bearings. Where are we on the chart? Okay. Here is, well, let me get the pen out, and that's what I meant to do. Here is yesterday's close or today's open. This is the first 10-minute candle of today. Everything to the right of this is today's activity. So what happened is we did have a slight gap higher in the morning, and you can see there's a gap above. So here's the gap, all right? So this is what I'm talking about. Now, when you go back to the daily chart, look over here, okay? So on the daily chart, there's a gap, and to fill that gap, for me, officially, is 291.99. Go back to the 10-minute chart, and you'll get a slightly different number, and this gap happens to be 292.02. And the reason you get a different number is because of the 10-minute chart versus the daily close. There's different closing numbers based on the different chart time frames and when each candle closes. But it's close enough. It's not the point. We had an opportunity on the gap higher this morning, and we sold off, so we had a failure. Then we had a turnaround. They started back up, and we began, after closing back above this breakdown candle high, we began making sideways, eating time off the clock, making sideways bullish flag pattern, bullish consolidation, and they could have pushed the market up to the morning highs and certainly through the morning highs at the time. There were moving averages up here. There was a gap. They could have done it if they wanted to do it. And let me go back to the daily chart and let me give you my rationale inside my brain. Remember, inside my head is a dangerous place to be. And this is why I say today's high is important, because look where we finished. The candle is red, finishing not on the low, but near the low. If we turned around and began tomorrow getting above today's high, we're likely to fill the gap, but we're also likely, in my book, to continue somewhat higher because we had an opportunity to fill the gap today. And therefore, I think if they go through all the effort to get above today's high tomorrow and fill the gap, I don't think that's all the intention would be. That's probably the best way that I can explain my thought process. How about the IWM? I think I've exhausted everything that I'm thinking in terms of the spider, so you get the point. And here we are trapped in between the 20 and the 50 period moving average in the IWM. Now, this is my favorite market leading indicator, and I have to make mention that we were up 1/3% today in the IWM while the spider was down. So is that an indication? Well, not really. It's not enough, right? It's up 1/3% versus down less than 0.2%. These are rounding errors. It's not enough to make me really have enough of something like an eyeball popping out saying, look, the IWM is doing this and everything else is doing that. We have to be aware. It's not that kind of divergence. It's too small. So we have a bearish pattern. That's the way I'm looking at it. And what we said yesterday, and I'll stick to this one, we're looking at really, and I know it's a little far away, before we had this breakdown candle high, but now we really have to look at the breakdown candle high from the 21st, the close of last week, which really is 171.82. That's the line in the sand in the IWM. If we begin closing above that, and if they take the trouble to get above that and close daily above that, then my belief would be they're going to close above the next breakdown candle high, which is all the way back here from the 6th of September, and then new highs would likely be coming. This is a bearish pattern here. If this starts to turn up, it starts not to look like a bearish pattern anymore. We have to be aware of where we are in the chart. And then we have to get below yesterday's low, which is also below the 50-period moving average, to have any kind of activity on the downside. And you have to have volume in the market. Like today, for example, the volume across the market was light. less than the average 90-day volume across the spider, across the IWM. When the volume is light, the path of least resistance is what? It's not down, it's to the upside. You have a lot of computer programming, trading going on out there, and when the volume is light, the computers have the ability to kind of shove the market around. They can bully the market around a little bit, and I don't really understand fully the mechanics of exactly how, who, why, and when all that takes place. So believe me, I'm not the expert in that subject, on that subject matter. All I know is when the market has light volume, it tends to go sideways to higher for the majority of the day, and those are the facts as I see them. Here's an intraday 10-minute chart of the IWM. I think it's worth mentioning. We had a gap higher, and we traded in a very narrow range all day long. Here's the high of the range, and here's the low of the range, and the low only is all the way down here because of the fourth 10-minute candle of the day, and also this one here. For the most part, the range was really in here, and look where we finished the day. At the end of the day, the last really 30 minutes of the day, the IWM sells off, closes below the 10-minute 100 period moving average. That's not really all that significant. When we move over to the 60-minute chart, do we see anything? What does my mind tell me when I look at this chart? What is my eye drawn to when I look at this chart? Well, what I see is I see a downtrending channel. That's the first I see. It's not a perfect channel, but it's a downtrending channel nonetheless, for the most part. I don't like perfection in the markets. When we look at channels, why do they have to be perfect? Otherwise, they don't count. I don't look at it that way. I just look at what I look at, and if it makes sense to me, then it makes sense to me, and hence common sense market analysis. And most of the time, if it makes sense, if it walks like a duck and it talks like a duck, it's generally a duck. And if 3 people tell you you're drunk, then you should probably go take a seat somewhere. So when I look at this, I see a downtrending channel, and I see a market that made a high. And let me point out the high that my eye is drawn to. It's the latest high. And then I see a market that made a low. And then I see a market that kind of made a retracement into some moving averages thereabout, not perfection, but it looks to be about halfway, right? Looks like about halfway home between pivot high, pivot low. We kind of retraced about halfway. And this is stuff that's out of the course at Lazy E Mini Trader, folks. I'm giving you snippets. If you want to learn the whole thing, you have to come over and check out the course. I'm telling you, there's a pile of gold in there. Now, what happens is, as we make this retracement into some moving averages, all of a sudden, in the last hour of the day, the market decides, or in this case, the IWM, being the market we're looking at, decides to turn back down, finishing near the low of the day. Is that bullish or bearish? It's not bullish, right? It doesn't have to be uber bearish, but it's certainly not bullish, and it is bearish. In my book, it has a bearish tone to it, if you will. Let's move on to the VIX, and in the VIX today, it really didn't move that much, and we're below all the moving averages. So there's really no new information from what we discussed yesterday. The levels that we've been discussing are really the levels that are still important today. We filled a gap down here. That's the spike through you see here. And really, that's really where we want to maintain above. It's that which is also the level of this last green candle low. That's a pivot that's important to this market. This is another pivot that lines up. This is a slight breakup candle, this pivot low. So this is an area that if you began to come down and close below this area, you're likely going slightly lower back into the 10s, maybe even below 10 at this stage. So in the VIX, this is the area we want to stay above on a daily closing basis. Today there wasn't much movement. On one hand, below the moving averages is kind of pushing the market down from an overhead resistance standpoint. On the other hand, remember the market did an interesting thing that we talk about from pivot high to pivot low. It went down for a specific period of time, and there are times, and when time lines up with price, and in this case, we talked about it when that happened a couple of days ago, when time lines up with price, you can have a trend change on your hands, and if we get a nice bounce higher, pop higher, rally higher over these moving averages, it could be game on for the VIX, and that could also be trouble for the equity markets on the downside if, in fact, it played out that way. We'll see. One day at a time. That's not what we have today. That's a hypothetical today. So let's go over to the transports, and what do we have? So this is interesting. So we talked about and have been talking about for a long, long time the breakup candle low, right? So we've been trading inside the breakup candle low for several days above the moving averages, and we talked about it. We said as long as that goes on, that's bullish, but we're at highs, and at some point in time, one of these times, they fail. And here we have, case in point, we closed below the breakup candle low yesterday. We have once again lower prices today by 59 points. In the transports, they were even down a little bit more earlier. And so we're coming down, but we're also in another area where there's likely a lot of support, right? The market consolidated for a long time in this zone. So we're still in an area where there's some chart support. We also have a safety net, not that far behind, 200.06, so 11,206, so a little more than 100 points lower than we are. We have the 50 period or 50-day moving average in the transports. Now, here's the weekly chart. So just as a refresher, look where the 50 period moving average is on the weekly chart. So A, the trend is up. B, it's not uncommon for a market to want to come back toward home base after getting extended or overbought or whatever term you want to use. And that's pretty much what happened on the weekly chart. The weekly chart got a little bit extended from its 20-week moving average or its home base. And what are we doing? We're coming back down toward home base. As time goes on, home base also creeps up toward price because home base is going from lower left to upper right. So at the same time, it's working in both directions. This is how markets work over and over and over again. As long as we remain above all these moving averages on a long-term weekly chart, the transports, there's nothing technically wrong with the transports or this long-term chart whatsoever, and we'll just leave it at that. This is nothing other than a garden variety corrective move in the transports right in front of us. The triple Qs. So the triple Qs got above the 20 period moving average today and closed there. Is that significant? Not really. We've been trading in and around the 20 for quite some time. We talk about this all the time. It diminishes the importance, in my book, of the 20 period moving average. What's our line in the sand? The line in the sand is the high from the other day. I believe it was Friday, the 21st. The high from there is 185.48. Any close below that on the daily chart, which will really also be a close above here. And if you're going to have the trouble to close above here, which is 185.48, this high is 185.55. So if you're going to close above one, you're closing above the other. You're going to continue up and make new highs. The trend remains up. And therefore, I will have at that point in time been wrong about downside imminent in the market. And we're likely making higher prices at the time. So I'm going to use Friday's high in the Qs as the line in the sand. Close above there, and for at least the time being, I'm likely wrong. Could they turn around and recapture it after the fact if that happens? Just projecting hypothetically something? Of course they could. We've seen that before. I'm just giving you my thought process, one market at a time, one chart at a time. The financials, the broker-dealer index, anything doing that we need to know of in the broker-dealer index? Not really. It was flat today. We're below all the moving averages. We know the weekly chart scenario. We talked about it yesterday. Nothing changed. Move it along. XLF looks a little more dramatic on the daily chart than it is. The span of this candle is like 20 cents. So still, we're down, okay? So we're down 1/3%. We broke below the 20 period moving average, and we're going to challenge this breakup candle low. And let's see what happens tomorrow. That breakup candle low is 28.23. That also will coincide roughly within pennies with the 50 period moving average at 28.20. So we'll see what happens tomorrow. If we begin closing below this price level and we begin closing below this pivot low, this is going to be an important line in the sand, I believe, for the XLF. 27.97, you begin closing below there at the time will likely coincide with right around the 100 period moving average, and there's likely more downside coming in the XLF, and there's likely downside happening at the time across other equity markets, because you know what I say about the financials. If the financials are going up, it's likely the markets are going up. A rising tide lifts all boats. It doesn't have to happen that way, but it does happen that way the majority of the time. It's unlikely you're going to get a huge up leg in the market without participation from the financials, and everything works in the reverse also. If the financials begin melting away, it's unlikely you have equity markets going in the other direction to a large magnitude. That's just the way it works under normal conditions. How about the SOX or the SMH? We don't have to look at them both. We can just stick with the SMH tonight. And you can see here that we were talking about the breakdown candle high, and if we were to get above the breakdown candle high, that would be bullish for the SOX, and if that was happening, that would be bullish for the Qs, and if that was happening, that would be bullish across all markets, just like we've been discussing over the last couple of charts. Well, look what happened today in the SMH. I find this intriguing. The SMH could be a potential canary in the coal mine. It certainly is a leading indicator across the tech sector. That's undisputable. And what's interesting is we had a very, very big down day in relation to what happened across other markets in the SMH. We're down 1.59%, $1.72. Got below three moving averages today, the ones we just got above and closed above yesterday, right? So, and we were down yesterday, then we were up, had a nice reversal. And here we had another reversal to the downside and closed below the 150 and 20 period moving average. That's interesting considering the NASDAQ composite was up 14 points today, or almost 0.2%, and the Qs were up about 0.2%. So what's going on there? That's interesting. We'll keep that in the front of our mind. It's a puzzle piece. It's on the table. It's certainly a clue. We need to be aware of things like this. What's doing in gold? Nothing's doing in gold. It's making a bullish pattern. Your moving averages are sloping down, holding down price. You have overhead resistance holding down the market. That's really what's going on. But what happens when this takes place is the longer this goes on, it's the market's way of coiling up and coiling up and coiling up. And eventually it's going to let loose. And it's like a spring. And it's going to shoot in one direction or the other. And out of a bullish pattern, it normally shoots to the upside. But the longer it goes sideways in this bullish pattern, the higher price is likely to go on the upside. And if it breaks down, the same thing is true because it's building up all this pressure that's ultimately going to get released. When it gets released, and in this bullish pattern, if it gets released, it's likely to go at least to 1240, potentially all the way up to the 100 period moving average, all the way up here at 1254. Now, why do I say that? Well, we have a Fed meeting that's taking place today, culminating tomorrow. Now, the Fed's going to raise interest rates 25 basis points or 0.25%. Now, that's built into the market. Everybody already knows about that. What's not built into the market is some kind of surprise. Maybe the Fed says something that spooks a market. Doesn't have to be the stock market. Maybe it does, maybe it doesn't. Maybe it spooks the bond market. Maybe it spooks the dollar. Maybe it spooks gold. When I say spooks, it doesn't mean up or down. I just mean when the Fed meets and the Fed does their thing, these markets tend to move in one direction or the other. Predicting it ahead of time is like trying to flip a coin and predicting which way a stock's going to go on an earnings announcement. It's a coin toss. Who knows? And this is the same thing, but this is a bullish pattern. And if it comes out of this bullish pattern, as it should, and it's built up enough pressure, it's going to come out pretty strong, and you're likely to get up to at least 1240, potentially even higher. So that's my story in the gold market. Pay attention this week because the Fed has their conclusion of the meeting tomorrow, and then I believe they have a press conference, if I'm not mistaken, so there can be some movement in these markets in reaction to whatever the Fed says, doesn't say, whatever's going to have their, or whoever's going to parse their words in one direction or another. Whatever, it's like a kabuki theater. We all know that, but either way, the market moves, so we might as well take advantage of it if we can. Crude oil. Crude oil did exactly what we said it was going to do. Nothing is different. Nothing has changed. Here's the high of the breakdown candle, 72.53. Here's the high today, 72.74. It's now, or yeah, that's the high yesterday. The high today is also 72.78. Now we're selling off back down to 72. Now we may go higher, but it's going to need to work off some of the short-term overbought condition. Look how far and fast we ran from the time we blasted off from when we were down at the moving averages. So it's gotten a little overbought. It's a little too far too fast. So either we go sideways for a while, eat some time off the clock, let price come down, or let the moving averages come up toward price, let price go sideways and or come down toward the moving averages. That'll give it enough energy or time to build enough energy to get through that particular breakdown candle high. If it can't, it's going to begin coming down, and the first sign that there's trouble ahead will be a close below yesterday's low, and we'll take it one day at a time, one trade at a time, 1 hour at a time. In fact, hourly also. You can count on that. An hourly close below that level will be the first sign. So that low is 71.14. You begin closing hourly below that level, realizing there's a gap down here and the market will whip around some, but that's going to be the first sign that that may be a longer term top than just consolidating to go up to 73, 74, 75, and so on. We may go higher. The jury will still be out for a little while, but a close below yesterday's low will be the first sign that things are not necessarily continuing to be as bullish as they might have been yesterday, for example. And with that, folks, I'm out of wind, so I'm going to wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.